So let's get right to it. Our guest tonight, Mark Kohler. I have known Mark for many years. Not like 20 years, but let's say like 7 or 8 years. He really is, as a real estate investor and business owner out there, Mark, he's a real estate attorney, and he's a CPA. So he's really got two brains, because you usually go to different people for this type of information, and you're trying to merge the two, and your CPA is telling you one thing, and then your legal guy's telling you another, but you need to coordinate them, and it can get really frustrating as a business owner or investor. So Mark's got both brains in one head, okay? And we've utilized his companies so much. I mean, his company, his people and his partners, we've gotten legal advice from them, we've gotten contracts, we've stuff going on, and we have them do our taxes. They've been great.
He's helped us save tens of thousands of dollars.
Yeah.
So, this guy's just a wealth of knowledge, national speaker, radio host.
And on this kind of a big, heavy topic, Mark he's so exceptional in his personality and the way he delivers it. You're going to get giddy and excited about tax and legal. I swear to God. You think I'm joking? I swear to God. So, I mean, with no further ado, my good friend, the man that saved me lots of money, that's kept me out of trouble, Mark Kohler, please. Come up here. Great, big hands.
Thank you so much. Thank you so much.
Yeah.
Mic'd up?
I was trying. I am mic'd up. So am I turned on now? I'm trying to, at least with my mic. There we go. We're good. I'm a loudspeaker. Yeah, we can turn that off. Yeah, we're good. And it was so awkward standing in the back with that wonderful introduction. So thank you so much. Now, I see a few familiar faces here and there. So I've got to ask right off the bat, just so I can start to kind of get my frame of reference for the tonight's topics. How many have heard me speak here before for an hour or two, or an hour-ish? Ooh, no, ooh boy, that's probably 10%, maybe 15% of the room. Man, I've been trying to work on some new material. I'm talking about my jokes, by the way, because I'm not worried about the tax and legal. That's the easy part. It's trying to keep you entertained and excited tonight. That's the tough part. Because aren't you excited to talk taxes? Woo! Yeah. Oh, man. Way fun, right? Okay, well, all right. I want to do a little more introduction here for 2 seconds. And I hope I don't screw this up. I want to move this forward. I know Andrew's probably running up right now. Oh, no, there we go. Okay, we're going to be working on the whiteboard quite a bit. So let me say this. If this pillar is in your way right now, please come sit up front. I won't call on you. It's not a stand-up show where I'm going to mock you or anything. Look at these chairs over here. I'm dead serious. 90% of everything you want to learn today is going to be on this whiteboard. So please kind of find a new seat. We're totally good. I'm totally good with that. Take your time. So, okay. Man. So there's about 15 or 20 of you that are new, that are regulars, if you will, that are drinking my Kool-Aid. Okay, so let me throw this out. So anyway, as Daryl and Emran said, I am a CPA and attorney, and I love small business. I was the kid selling the lemonade stand as a kid. I love small. I went into business, and I thought accounting was the. I'm going to try to do my best with this pillar. I feel bad, my man in blue here. So as I move around here, but anyway, see, I'm going to be stuck right here. This isn't good, so I'll try to do my best. I am going to move around a little bit, so you're going to have to live with that. I'll go crazy. So anyway, so I've loved small business, and I went into college thinking the blood of business and the language of business is accounting. And I was not, I was probably a nerd, but not a nerd accountant. I just felt, I need to learn accounting because I feel like I can talk and communicate, which the average accountant struggles with. No offense. Sorry. Any other CPAs here tonight? Okay, sweet. Okay, so they're throwing them into the bus. But I mean, this is why I'm so proud of you here being tonight. The number one cost in our lives are taxes. Number one. Hey, we all live in California, right? Holy crap, right? Taxes, if it's not state tax, it's federal tax, it's property taxes, it's killing us, right? We've got to be on our game. But who's the number one industry that's supposed to help us? Oh yeah, the people that don't like to communicate and are scared of their own shadow, right? I mean, seriously, our accountants, they don't want to have a conversation. Heaven forbid they strategize. It's like, give me your crap and walk away. They went into accounting so they don't have to talk to anyone. Seriously, right? And that's our resource for this. So anyway, I went into accounting because I felt like accounting was the piece that I was missing in business. And of course, I ended up being the class president and throwing all the parties. And I was the C student. I'm still a quality accountant, I want you to know. But I hire all the A students now. So that was me in college. And I just love accounting. I love it probably more than the law. Because the law is always, it depends, and there's always an argument, and blah, blah, blah. But with accounting, there's always an answer. It's got to add up. It's got to balance. So I like that part of accounting. So anyway, so that's me. And I grew up in Washington State. We ended up moving to Utah. I was born in Oregon. And gosh, I've got to keep this brief. But we're here till what, 9:15 maybe? Oh, woo! All right. So anyway, I was born in Oregon. I'm actually adopted. I don't know my real parents. Oregon is a right to know. Is that what they call it? The state? I don't know what they even call it. But you can find out who your adoptive parents are. I've never done it. I'd kill my mom. But I was born in the 60s, 68. I know, ladies, I look a little younger, but I'm. It's a joke. But anyway, so I love the 80s. But so I was born in the 60s, so I was born in Eugene, Oregon, which is, hippie capital of Oregon. So I believe I came from Woodstock, my parents came from Woodstock, stopped in Tijuana. I think I was conceived in Tijuana, then born up in Eugene. And they seriously had a Volkswagen bus because my parents pulled up at the law office. They drove away in a Volkswagen bus, and I was sitting in a box. That was me. So, and my parents are phenomenal. They're my heroes. But I was born in Oregon, raised in Washington, hated the rain, so we moved to Utah. So our home office for our law firm and accounting firm for the last 12 years is in southern Utah, Red Rock Desert. So I went from one extreme to the other. So if you were ever to work, and I know many of you here well, not many, but 10 to 15 of you that are here, I know have used our office before. And so our main office is in Utah. It's our own little India, cheap labor, cheap space, and it just works for us. And then we have an office in Phoenix with a skeleton crew, and then an office in Irvine, and I did it for you. We opened another office just so you guys could have a tax write-off. So we opened an office in Honolulu, and I really didn't want to, because if I have to meet you over there, it's kind of pain to go over to Hawaii, But anyways, but we did open a little satellite office in Honolulu. I speak over there actually 3 or 4 times a year. It's a perk, and my daughter's now going to college there this fall. So if those that follow me on Facebook, you maybe saw a little Facebook note this week. But anyway, so we have our little offices, but we're really kind of a boutique firm, and we like helping small business owners save taxes, protect their wealth, and coordinate it with your estate plan. We're more lovers than fighters. We want you to help raise money, use your IRA, raise capital through a PPM, set up your LLC, your corp, save taxes, bring it all together. And I'm going to give you my hottest tips in our time tonight of some tips to think about for this year, your basic structure and what it should look like. For those that have seen me before, so here's an important point or two. I've got a couple books. I want to raffle off my book. I'll tell you about my book in 2 seconds, and we'll jump into the meat of it. But I want you to feel confident in what I'm talking about tonight. Some people are like, man, he's like not a normal accountant. He's too aggressive or this or that. Guys, we are signing thousands of tax returns. Well, this year we'll probably do about 2,200 is our goal, 2,200 tax returns in our little firm across the country. We have more clients around the country than in one state. And so I'm ex-KPMG. I clerked at the S-Corp. My other partner's from Arthur Andersen. The other one's from Deloitte & Touche. And we really take a really careful approach to producing a quality tax return, but we're cautiously aggressive. And so tonight I want you to know my background so that when I give strategies, you may go, what the heck? My CPA is not talking about that. Well, what's wrong here? And who's right and who's wrong? And it really is with a tax return. So many people feel like it's a commodity and a return is what it is, but it's not. A tax return is a work of art. It could look like who knows what, right? It's an open tapestry to me. I just love it, writing, coming up with strategies that there's a lot of gray areas. And if your documentation's right on and there's options for writing something off, I'm all for it. So anyway, for those that have heard me before, I need to hit the basics for the 90% of the room. They need to get the Kohler doctrine down. Some people call it a Kohleroscopy. It's not going to be comfortable, but you're going to feel a lot better when it's over. And so for those that have had me before, we're going to kind of get into those basics, and then I want to take as many questions and answers as I can. So for those that have seen or heard me before, if you want to throw out a targeted difficult question, that's cool. I'm going to be all over the board, but I'll hopefully bring it all together. But those that want more content of me, I've got a weekly YouTube tip that's free every week. I've got a weekly radio show and podcast I've been doing for 8 years. There's over 400 live radio shows in the iTunes podcast library. I've got a weekly newsletter and blog articles that are free. A lot of free content. And tonight I'll raffle off my book, and for those that want to be on my newsletter, I'll grab your business card before we finish up, and I'll raffle off my most recent book. I have a new book coming out in a couple months, I'll mention. But if you want more content of me, I do have a tax and legal library with 30-minute videos on all sorts of topics that are more involved with the whiteboard in my little studio at the office. So just know tonight, if I skim over something, you can certainly get more information, and don't feel like I'm trying to hold back the ball. We'll get as detailed as we can, but there's obviously we can't talk about everything. So that's who I am, and I hope you can start to follow some of my information. You don't have to use our firm, but hopefully I can help educate you on some topics that maybe you're not aware of that you can take to your professionals and use. So anyway, I've written 3 books. I don't even have a copy of my first book. It is sold out. The only place I can get it is a used copy on Amazon. And if I see it's a book that I signed for you, I will track you down. No. There's a couple of used copies. It's selling pretty strong. It's over $20 for a used copy. It's called Lawyers Are Liars. Oh, any lawyers here tonight? Okay, now it's just a discussion point. There's so many scams out there that call lawyers liars. And I had a phone call this week. Kendall, this is Kelly. I'm going to bring up Kendall a little bit. And I saw Darren in the house too. See, these are partners, and they're kind of like a married couple now. They don't even sit by each other. So it tells you about their partnership. Yeah, we'll bring it. We'll talk. Business partner. Yeah, sorry. Yeah, I meant that. Sorry. We are in California, so I want to be clear about the partnership relationship. Anyway, so where was I going with all this? Oh, so with the book, Lawyers Are Liars, just this week, I was going to say, I had a client call me up. She goes, Mark, and this is men and women. I don't want you to feel like this is an epidemic with the female investor. It's certainly not. But I had this woman call me up this week, and she goes, Mark, I need your help. You got to just explain how to bring this all together for me. And I go, what do you got? And she goes, well, I've got 3 companies. I live here in California, and I've got 3 Nevada companies, and one of them's a corporation and 2 LLCs, and I'm just getting started. I'm on Social Security disability, and I just started my business. And I go, how did you end up with these 3 companies? Well, she goes, well, I went to this class and this workshop, not Renatus, and as soon as I was done, I got a series of phone calls from this company out of Nevada that sold me these 3 entities. She was into it $5,000. I almost get choked up. And I had to tell her that she doesn't even need them. And it broke my heart. And this type of crap happens all the time, and it just pisses me off. And here in California, that Nevada sales pitch is very, very common. I need a C-Corp in Nevada. And yeah, like California's not going to tax me if my entity's in Nevada. Yeah, that's surely going to work, right? So it's just ridiculous. So I wrote my first book called Lawyers Are Liars, and the scams to avoid is the first half of the book, and then what really works in asset protection. Sold over 15,000 copies across the country, and it's sold out now. I have it on ebook and PDF tonight if you want it. Ebook and PDF, same thing. Ebook and audiobook if you want it. But it's great. I finished, and those that know me, sorry, this is my, this is the classic chapter of the book, is I finish with the chapter on the father of asset protection, O.J. Simpson. And it's just awesome. So you can be like O.J. too, be in Clark County Jail, have all your assets. It's awesome. He's going to be out on parole 3 more years, and it's another chapter. I'm so excited. There's lots of good stuff. So really excited with that. Now then everybody was like, well, Mark, you need to write the tax book. And I chose to write the asset protection book first because of the scams that I see so often. So my second book is titled What Your CPA Isn't Telling You. And my publisher was Entrepreneur Magazine. They saw what I was doing and said, you need to write a tax book that people want to read. So I wrote 13 chapters. I sat down for like 4 months. I'd go to Starbucks at night and just write. And my wife was thinking I was crazy, and why are you writing this book on taxes? And I wrote my 10 top tips, and blah. And I sat down to proofread my book repeatedly, but I sat down one night to just read it from start to finish, and I fell asleep. And I said, this is stupid. You don't want to read a tax book? Are you going to go home and read a tax book? No. You're going to read 50 Shades of Grey, you know? Yeah, that's going to be a lot more exciting, right? Sorry, no offense. So this was tough. So I threw away the book and started over. And this was 3.5, 4 years ago when my new favorite show, Modern Family, was out. So I decided to write a book that's a story. And it's a story of this family that meets this young, good-looking CPA. It's autobiographical, and he changes their whole life because they catch the vision that, oh my gosh, tax planning is where it starts. A penny saved is a penny earned. If I can live within my means, if my business could die or fail based on this 30% tax rate, and what am I taking home, and am I making deposits, and all these little pieces apart. Everyone wants to go to the class, oh, I can make more money, and I can do this, and I can do that, but then they don't want to talk about QuickBooks, and keeping receipts, and all the little things that at the end of the year could make your business sink or swim. And so I wrote it as a story, and you can't put it down. Here, I'm just going to read the first paragraph. Okay, now, buckle up. Okay. It was a dreary day in March. You know the type of day. It was cold. The flowers had not yet started to bloom. One didn't know if it was about to rain, snow, or just stay cloudy and bleak. What made the day even more unbearable, it was the day we went to go see our accountant. It wasn't a meeting we looked forward to. Sometimes we would talk over the phone or simply drop off the paperwork. But today, however, we were to meet. And then it goes on. And you can't put it down. And it happens. And I want it to be a made-for-TV movie, so I've got death and divorce and good kids, bad kids. I even work in a sex scene. It's a little subtle, but when you find out Viagra's tax deductible, woo! You know, seriously, yeah, that's pretty sweet. I know you may be more of a Cialis guy, but yeah. So, but it's totally tax deductible. We get a tax write-off for everything in our house. But anyway, so it's got all sorts of tables and charts in the back, but the bulk of the book is a story, and it makes it fun to learn about taxes. So that's my second one. My third book comes out April 15th, published by Entrepreneur Magazine again, and it's titled The Tax and Legal Playbook, and it's got X's and O's and a clipboard on the cover, and it's 28 different strategies in about 4 or 5 different areas. So taxes and asset protection, estate planning, and self-directing your IRA, and it brings a lot of my teachings over the years all together in one book. So look for that. So hopefully you get on my newsletter, you'll see it come out in just a month and a half. So anyway, that's me, and so let's dive into it. Woo! Sorry, I just got, I want you to know what you're dealing with here. All right, so boy, it got quiet too. Turned off the fan. All right, AC. All right, so here's the deal. Okay, we're still good here. Sorry, Kendall, you've seen my whiteboard action before, and we want to say thank you to Andrew for this amazing whiteboard. It's made of glass, if you guys didn't know that. It's so cool. Okay, so I got to move it this way a little. I'm right-handed. So the first topic I want to hit here for a second is let me build the foundation. Now, for those that have heard me speak before, this is just, again, good Kohler doctrine, getting used to my Kool-Aid here for a minute. But we're going to get what happened here? You can turn it down a little, I'm pretty loud. We're going to get more and more technical so your brain blows up by the end of the night, I promise. So, okay, so here's your tax return. Now, some of you may be playing with your 1040 on TurboTax right now. It's tax season. It's a busy time. So you got your 1040. What's this number in the bottom right-hand corner? Now, just work with me. We're going to start big and zoom in. AGI stands for Adjusted Gross Income. Now, this little line right here is the infamous the line. This is what President Obama and Mitt Romney were debating about in their presidential debates. Above the line, below the line. Now, what's better, a deduction above the line or below? Above. We want deductions above the line. So many millions of Americans pay taxes and they pay for crap below the line. But if you have a small business, and you wouldn't be in this room if you didn't already have a small business, which could include owning real estate. So if you have a small business, there can be a lot of expenses that are now deductible above the line. In my articles, in my book, I call these personal conversion expenses. Because they're personal expenses that you're going to pay for anyway, but if I can write them off as part of my business, I now save taxes. So for example, some of these are your home office, cell phone, travel, dining, entertainment, PDAs, laptops, everything at the Apple Store, Best Buy. Are we being aggressive enough with all these little gadgets and gizmos we buy that they've got to relate to our business? If I'm going to buy a rental property, my property manager better be able to get a hold of me on my cell phone. My cell phone's now a write-off. And there, for those that don't know this, it's been 2.5 years now, but I constantly find shock in people's eyes. There was a case with the IRS where the taxpayer won and the IRS acquiesced. That means they gave up. And a cell phone is now 100% deductible, even if you use it for personal use, so long as you need it for your business. Now, the only caveat is you have to have a home phone line. Now, that may be a Magic Jack, it could be an IP phone, maybe Google Voice. Now, that could affect if we write off your internet or not, if the internet serves as your phone line. But many of you that are maybe bundling your data or bundling your cable at home, you may get a free phone line as part of that. Take it, use it, grab it, because now your cell phone becomes 100% write-off. And your kids or your spouse, because they all should be working in the business. My spouse is on my board of directors. All my kids are employees or on the board. We all work together. It's a family business. I got to be able to get a hold of my employees. I had 2 of my daughters at my office today working. Molly's dying to come this weekend and do her jobs. I'm excited to say she got a little promotion. Kendall, this is exciting. She's my paper shredder administrator. She's 11 years old. And many of you have seen pictures of, not many of you, some of you have seen pictures of her. And she's been bucking for a raise and a new position, even though she did get Employee of the Month a few months ago. But she is so above shredding. She hates it now. So now she is the recycling coordinator. So she gets to now take all the cans, and it's a little cooler to go down to Albertsons and get these things sucked into, the recycling machines. And part of her pay is to keep that receipt when it comes out. But she has to show up for work and get all the cans in the office, clean the office, vacuum, and shred. And so all the kids are involved in the business. We'll talk about how to put your kids on payroll tonight if you want. But the point is, there's so many expenses that the average American misses out on that could be converted to business. Just running some rough numbers, and some of you have heard me use just the cell phone example comes to mind tonight, is that if you're spending a couple $100 a month on cell phone, data, blah, 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 maybe you've got spouse and kids on cell phones, you could be spending $300, $400, $500 a month, right? So, but if it's just a couple $100 a month, that's $2,400 a year that you're not getting a write-off for, maybe, I don't know. But if I can write it off above the line, and you're in a 30% bracket, your AGI went down by $2,400. And if you're in a 30% bracket, that means I just saved 30% on the taxes that I would have paid on that. So 30% of $2,400 is $800. Woo! $800, that ain't chump change. That's paid for a new iPhone something, right? So, but $800 in tax savings just because I'm tracking one extra cell phone in my family. Boom! And we're thinking outside the box and all that. So I know many of you, Daryl and Amaranth, they've brought, keep me up to speed on the character and quality of their students. So I know that many of you are small business owners. But for those that are just starting to dip their toe into the water of rental real estate or real estate investment and starting to get educated and spending the time to do that, the tax planning opportunities are amazing. So first point tonight, I need everybody to have a small business. And to start a small business, it's technical. You don't need a DBA, you don't need an LLC, you don't need an S-Corp, don't need a tax ID number. All you have to do is say, I'm in business. That's it. For those, I won't make you do it. That'd be kind of dorky. I'm not at a Tony Robbins event. But you all should be saying, I'm in business. And at least you're in startup mode. You may have not made a sale yet, but you're setting up your lemonade stand. And when you start to sell that first cup of lemonade, you're in business. So expenses you're incurring tonight, mileage over here, cost of valet, some food afterwards, networking. That, if you even commuted outside of your normal commute to be here, you can eat by yourself and write off your dining. So tonight is a tax deduction. You buy a little education from me, or you plan to get more educated. Those are deductions in your business to create more income. Code section 61 of the Internal Revenue Code. Any expense incurred in the production of income. Sorry, code section 62. I apologize. I know you were getting ticked, but no, I got it. I could feel it. I could feel it. But this is incredible. We need to be thinking outside the box and turning our hobbies into businesses, trying to find ways to write off every trip, travel, dining, mileage experience. And tonight is a write-off. So keep track of these expenses, even if you haven't made money yet in your small business, because we will be able to write it off when you have that first dollar of income. So that's point number one. Thoughts or comments on that before we move to the next topic? Anything? Just kind of basic or something on that? I'm all yours. Oh, look at this. Oh, it's like a baby's bottom. Oh, man. Oh, this is, you just want to just, oh, never mind. So anyway, okay. It's pretty, so sexy. Okay. It's like a dream whiteboard. So, next major principle. And I don't have time to kind of build upon it, so I'm going to jump 3 or 4 steps up. Now, this is important. What real estate investors often don't understand, and I'm not talking down to anybody here, I'm just throwing out my point, is that real estate it has to be divided into 2 camps, short-term or long-term. Short-term deals, ordinary income, long-term deals, passive. And the sooner we get that down pat, we can do better asset protection and tax planning. So if any one of you walked into my office tomorrow, or we got on a phone call and Skyped or go to meeting, the first thing I would do is create a line on the wall or on my computer screen for you, and we'd be talking short-term and long-term. This is ordinary income. Now, your first choice now, give me examples of ordinary income real quick. A fix and flip. Okay, in real estate, fix and flip. And you hold it less than 12 months. Burp, burp. What else? What else could you do to make some ordinary income? Wholesaling. Boy, look at all these real estate investors. Any realtors in the house? Where are my realtors? I love you guys. Woo! Commissions. Ah! Gotta love that 1099. A rehab. Now, a rehab could morph into a long-term hold, but it may morph into a fix and flip. Kind of rehabs are on the bubble, right? Long-term. What's examples of long-term income? Buy and hold. Buy and hold, which creates 2 types of income. What 2 types? Well, depreciation would be a deduction. Does someone say appreciation? Okay, appreciation is another word for what? Starts with a C? Capital gain. Woo! What else are you going to get with that buy and hold? Rent. Now for those, where's my note investors? Know you're in the house? What do you love to get? Interest. And points, which are classified as the same. Interest and points. And then our long-term REIT investors and others and who knows what, we got dividends, we got royalties, all this good stuff. Now, when I meet with a client, I say, what type of real estate are you doing? Short-term or long-term? And some of you may say, oh, I'm all long-term. I got a day job I love. And I'm just going to buy and hold. I'm going to be buying rentals in Atlanta. I'm here in California. We know buying rentals in San Diego can be precarious. I don't own any of my rentals in California unless I'm going to, well, I don't want to insult anybody's hometown, but it's either going to be Fresno or Barstow. Other than that, who knows? But it's going to be tough to find a cash flow rental in California. So I'm renting. My rentals are out of state. But you could be a rent, buy, and hold person. Some of you are like, Mark, I don't want rentals right now. I just hate my day job. I got to create income. All right, that's cool. And so you're going full-time real estate, professional, for lack of a better word. Some of you may be doing both. That's cool. But we have to make sure we're separating this for tax planning and asset protection. So on the short-term side, when you're creating ordinary income, what tax hits us here first? Before state tax, federal tax, Obama, payroll. Also known as SE tax. SE tax. What's the rate on SE tax? 15.3%. Now if you work for someone else, this kind of sucks. As a small business owner, you may go, this isn't fair. Because if I work for someone else, how much do they withhold? 7.65, and it's for the F word. FICA. FICA. And FICA is made up of two parts. What? Social Security and Medicare. Okay, so if I work for someone else, what does the employer have to do after they withhold? Match. 7.65. Look, they still got 15.3%. So whether you work for the man or work for yourself, the net income is going to get hit with this 15.3%, which sucks for Social Security and Medicare. So for the small business owner, when they start going out and doing a little rehab or a fix and flip, or they're a brand new realtor, they're going to say, I'm in business. And if you say that, what are you by classification? Are you a corporation? What are you? Sole proprietor. So I'm this cute little sole proprietor. And if I get out and kick some butt and do a couple flips, or I get some commissions and I bring in 75 grand and I kick some butt, maybe I have 25 grand in expenses. I write off everything under the sun. Mark's got me dialed in. I'm writing off everything. I net 50. Self-employment tax, 15.3. So I pay $7,500 off the top before I even do state and federal. I mean, I'm getting hosed here, right? And all of a sudden, all your profits are going. Oh, but you didn't take your profits and save it for taxes. You reinvested them in the next deal. So all of a sudden, it's April, and you're like, oh, what the hell? I mean, I got this tax due, and my money's tied up in my third property. That's scary. So this self-employment tax can be a nightmare. So, of course, we get sold and 50 years ago, the only thing you could do is set up a C-Corp. I know for those that have had me before, this is review, but I want to get everybody on the same page. We might set up the C-Corp. Heaven forbid we do it in Nevada. But we set up the C-Corp, and I make the same 50 grand. It's not self-employment tax. What's killing me now? Corporate tax. So now 15 to 30% corporate tax, and then I take my draw, and I can't write off anything more. I've already written off my 25, and this is where the sales pitches are. Oh, you can write off everything. You can zero out your C-Corp. Well, my goal is to take some money home at some point. So my C-Corp isn't going to zero out entirely. You know, I got to buy groceries and underwear, you know. Even though that Victoria's Secret is an entertainment expense. I mean, it's you run out, you know. So it's brutal. So the C-Corp doesn't work. I would say out of 100 clients of mine, we might have one C-Corp in the mix. And it's under the healthcare strategy, which we could talk Kohler Eyre. It's a sweet strategy, but we may get that out later. We'll see. So this brings us to 1968 when everything changed and we got the beautiful S-Corp. We get the asset protection of a C-Corp. Love it. Bring in the 75, spend the 25 on expenses, net the 50, no self-employment tax, no corporate tax. See what I'm saying? Huge. Now for those out there that have an S-Corp, do you really not pay any self-employment tax? Do you escape it all? No. We pay something, right? And this brings us to the Kohler salary dividend split and the Kohler matrix it's taking the country by storm. And we're going to hit it. You're going to love it. So what we do is we find the right percentage under the Kohler payroll matrix, and we take the right W-2, which in this situation, we might do 25 grand in a W-2. Your K-1 just turned into 25 grand. Well, Mark, I'm still going to get taxed on 50 grand. So why did I do this? What tax am I saving? Self-employment. I'm only paying SE tax on the 25. The other flows through as a dividend and escapes Obamacare too. So now, the more money I make, the more I save. So if I'm doing 15.3% here and saved it here, I just cut that $7,500 bill in half. So I just saved $3,250 by going to an S-Corp. Now some of you are like, oh Mark, we live in California and oh my gosh, this is $800 minimum tax every year. You don't know what you're talking about. Well, let me see. I'll spend $800 to save $32. That makes sense to me. Gosh darn it. You know, heaven forbid. But now, I do need to say, by the time you do your tax return, and this is why there's a break-even point with S-Corps. One of the common questions is, when do I set up an S-Corp? Now, if you need an S-Corp for asset protection and you're selling, you know, tacos in a truck down and everybody's getting botulism, you may need an entity, you know, I hear you. But, and I've had those tacos, they taste so good. The first time, but not the second time. But when you set up your S-Corp, you're going to spend $800 minimum tax. You can have about 250 grand net income before the 800 goes up. So you're going to make 250 and lower, pay $800, but you're going to have to pay for a tax return. And the average S-Corp tax return, even at H&R Block, you're going to range between $500 to $1,000 for a corporate return. And then you got to do your payroll reports throughout the year. Costco even has this service for S-Corps. When you walk in, they got a little pamphlet over there for S-Corp payroll. But anyway, you're going to pay about $400 a year, maybe $500 a year for that. So the bottom line is, you're going to be out $2,000 to maintain an S-Corp. No, I'm not holding anything back. You're going to be out $2,000. Now, the first year you set up an S-Corp, the $800 is waived by the state. So there's your setup cost. Ironically, at our office, we charge $800 to set up an entity plus filing fee. And we didn't plan that, seriously. But we set up any entity in any state, $800 with all the attorney consult you need, with a real attorney on the phone or in person walking you through an entity. So it can be affordable. We don't need to spend $5,000 like that poor little lady I met this week. So you're going to be out $2,000 the first year, whether it's a filing fee or getting it set up or in that. But again, if I can save $3,000, why not spend $2,000? And so what happens is the break even, especially in California, is around $40,000 to $50,000 net. If you're going to net $40,000 or more, let's get you into an S-Corp. If you're going to be below that, we might do an LLC for asset protection, but call it a single member LLC and just run your business through it, and then we can convert it to an S-Corp later. So anyway, let me make one more point, then we'll do Q&A. Hold on. Let me make this point. So we'll come back to the S-Corp. But on the long-term side, this is where everything else comes into play. The LLC, the LLP, the LP, the Series LC, the double L, triple LP, the blah, 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 all this alphabet soup. Do LLCs save taxes? No! LLCs do not save taxes. You do not need an LLC to save taxes. Why do we do them? Protection! Because the LLC is going to own my rental. Or I could have an LLC for a partnership, but I got to funnel my money through my S-Corp. So I could use an LLC for a rental or a partnership, but my S-Corp is for my ordinary income. So this is the brother-sister relationship that we want to build upon. So if for my average contractor, realtor, real estate professional, engineer, lawyer, dentist, doctor, CPA, attorney, we're all S-Corps. We've got our S-Corp on this side, and we got our LLC over here. The LLC owns the rental, the S-Corp runs the business. This is the building, this is the business. This is the dentist, this is the dental building. This is the restaurant, this is the restaurant building. Please do not think Applebee's owns the building that they still run the restaurant in. They don't. They're two different companies, Applebee Holdings, Applebee Restaurants. Boom, we have a firewall. And I want you to have a firewall between your assets and your operations. Woo! Man, I get so excited about this. I'm dorky. Okay, so let's beat it up for a minute. Thoughts and questions, comments. What do you think? Question? Yes, sir.
Now, you decided to pay half as a dividend. What dictates that ratio and how high does it go?
Dude, you're awesome, and I did not plant him in the crowd. Okay, this brings up the Kohler payroll matrix. Now, for those that have seen me before, right, someone walked in and said, Mark, it's been a couple years. You're going to love this. I just developed this last year. I've been trying to explain it for, 8 or 9 years. And we've done thousands of S-Corp tax. Okay, let me make a couple disclaimers. We've done thousands of S-Corp tax returns over the years. We have never, knock on wood, we have never had a client audited for taking too low of a payroll in 12 years. I've had multiple IRS agents on my radio show, ex-IRS agents, or retired IRS agents, because a working IRS agent won't come on my radio show. But I had an IRS agent out of Chicago that audited S-Corps his entire career. Said, Mark, I love your payroll strategy. But what you're going to find is 60% of your CPAs out there who are afraid of their own shadow and taking a risk, even if you demand it, they won't let you do it. So here's the matrix. All right, let's do this in black. Okay. So, you're going to love this. This is some blog articles and some writings of mine, but got more in-depth videos on it. Okay, so let's do this. As your income goes up, now this is your net income. So maybe, I don't know, 25 grand here, 50 grand, 100 grand, blah, blah, blah. Your payroll as a percentage of your net income actually goes down. So this is payroll as a percentage of your net. The sweet spot for all this is right in the middle at about 1/3, 2/3. That's where we play most of our games. So if I'm making 100 grand net, my payroll is going to be about 36 grand or 33%. So in my S-Corp, 36K payroll, I just sent an email today to a client. I said, knock out your payroll, 36, boom. 36K payroll, 64 K1. 15% savings on 64 grand. Oh my gosh, $9,000, boom. So if you're making 100K net, so maybe you're bringing in 130, 120, we got 20 to 30K in write-offs, you're netting 100, we want your payroll about here. Now, I've got clients that are making 400 and their payroll's 96. So their payroll percentage is actually down to 25%. Now, if I'm making 50 grand, I might be closer to a 50% ratio. So the payroll percentage goes down, but it's higher over here. So if you're going to net 20 or 30, your payroll is going to be so high, you're not going to save anything. So that's why the break even for me is around 40 grand. So in most states, California a little higher, 40 to 50, because we have the 800 minimum tax crap. So the more money you make, the less payroll we can take as a percentage. Now for those of you that are establishing your payroll right now, because payroll's due next freaking month, and your accountant's you're gonna walk into your accountant and go, hey, I went and saw this Mark Kohler and he was saying, my payroll needs to be down here, and they're gonna go, beep, 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 beep. You're gonna get audited, can't do it. You're gonna say, either you're gonna do it or you're fired. Now I don't care if it's your sister. I don't care if it's, oh, he's been our accountant for 15 years and he's so nice and so smart. He's costing you thousands of dollars. And I'm sorry, get upset. I've been sick and tired of this crap. I was on a phone call with a client today. He was out of Chicago. He goes, Mark, I've got the best accountant. I've been with him for 15 years, da-da-da-da-da. And he goes through the fact pattern. I'm like, dude, we were talking about a loss on a business adventure, and his accountant wouldn't write it off. And I'm like, capital loss? No, this is ordinary loss. $125,000 loss that he wanted to capitalize at $3 grand a year. And I'm like, what? And he's like, yeah, but he's a great accountant. BS! Jeez. Now, if you don't want to use my firm for your accounting, fine, shop around. That's cool. We got a little waiting list. We're going to, after extension period, we'll be taking new clients, but you can get on our list if you want. But the thing is this is the real deal. And every dentist, doctor, engineer, lawyer, CPA, realtor, contractor, developer, real estate professional, making ordinary income, the S-Corp's where it's at, and it's the #1 way to first save your dollar. Woo! Thank you, I appreciate that. Woo! You want to give it a slap? Woo! It's butt slapping fun. Okay. Aren't you excited? You weren't that excited. That's okay. You'll get better. Yes, sir. You're in accounting classes?
No.
Oh. In high school. You're in high school? Oh my gosh. How many of us wish we were learning this when we were in high school? We are so proud of you. That is so awesome. Don't give up.
She's one of my tax write-offs.
Oh, wow. So this is Dad right here. Nice. Wow. Very impressive. Okay. Yes, sir.
Okay, so when you switch over from LLC to your taxes, the self-employment tax for all your income, you switch over to S-Corp, and you do some payroll plus dividends or different distribution for the rest of the income.
Mm-hmm.
Is that dividend distribution, you about your car loan or house loan, is that extra income, or are they still going to count as regular income?
Yes. Now, the more sophisticated lender you work with, now let me repeat his question if some of you didn't hear it. I think there's 2 or 3 in there. The first question was, what distribution, dividend, LLC switch to S-Corp? There's a couple comments I want to make on that. But then the heart of his question was, Mark, I got to go sell this to my banker. You know, I want to get a freaking loan at the end of the day. And if you make my tax return look so freaking awesome, and then I got to dress it up for my banker, how many of us deal with that, right? Heaven forbid a banker understands what a corporation is. Jeez, it's like Fannie Mae and Freddie Mac left those chapters out. Gosh. Especially, you know, heaven forbid it's a credit union. It's like, boom, you know. Jeez. So the more sophisticated lender you have, they're going to take your S-Corp, look at the K1, look at the salary, and those are combined income for an AGI. Most of your loans are going to be based on your AGI, not always your W-2. So if you can prove other sources of income with a K1 from an S-Corp, you're going to be fine. Now, if your banker's giving you a hard time, find a new freaking banker. Send me an email, I'll send you a couple referrals myself. I know, any bankers in the house? Any lenders in the house? Look at this right here. Am I wrong? You're cool with that? Get this guy's card. Where was the other one? Raise your hand. Get 2 cards in here. There we go. These 2 guys here. Get a card. You want to find sophisticated lenders as real estate investors. So I think that's a great comment. Now let me make a comment here too. He said LLC taxed as an S-Corp. You can have an LLC, and some people start out as an LLC doing ordinary income. That's fine. Then you can convert it to an S-Corp. You can actually backdate it up until a year ago. We just got to catch up on the payroll if needs be. Today, I had a client that made almost 200 grand last year. We literally made an S election back to 1/1/14 and took a payroll today. Even though it's late payroll and it's a 10% penalty on the payroll tax, he's still going to save close to 10 grand. So we're like pulling out the stops to get this thing done because the S-Corp extension deadline is in 9 days. No, 11 days. Sorry, it's the 4th, right? Is it the 4th today or 5th? 5th, so 10 days away. So we're up against the wall here if you need to make that election. So the LLC can change to an S-Corp. Then his second point is how is this classified? You take a draw anytime you want. It's not a big deal. You just take a draw. And then quarterly, my payroll clerks call you up and go, hey, how'd you do last quarter? 4 quarters in the year. In April, you're going to get a call, and they'll go, how'd you do the first 3 months? Oh man, I was killing it. I brought home 30K in draws. Sweet, you already took the money. Now, I would hope you'd set a little aside for taxes. We can strategize about that one-on-one, but so you got 30 grand. So if you took 30K in draws, what should your W-2 be? Just based on the matrix. You're killing me. What should your payroll be if your draw's 30 in the first quarter? 10 grand. We want to start out safe, 1/3, 2/3. We can true up your payroll in the 4th quarter if we need to. But you need to take payroll throughout the year. You can't wait until December of the year. You go, oh, I'll take payroll now. Do you think their IRS might want your money during the year? Yeah. And then you get a nasty letter and no one wants that. So anyway, it's called a draw. And then quarterly you do a payroll report and you claim how much of that was, that draw was payroll. And so any ordinary income you make, I want you to only have one S-Corp in your life. You could be doing rehabs, fix and flips, wholesales, commissions, selling jeans on eBay, importing shrimp from Malaysia. I don't care. Do it all in one S-Corp, but the money's got to funnel through and launder. Sorry. We've got to clean the money here. Now, for my Breaking Bad fans, where are my Breaking Bad fans? Oh, woo! This is the car wash, okay? Skyler is cleaning the money for us. We're taking part payroll, part K1. Woo! So it's a draw. Don't stress about it. Take the profit anytime you want. Have a separate corporate account, personal account. Move money over to your personal anytime you want. Use online banking. Claim your payroll quarterly. You're dialed in. Once you get the feel with it, the first 3 to 6 months, it becomes an old hat. Very common. Is there a hand? Yes?
For looking numbers for doing evaluation on a property, I got a spreadsheet set up where I'll have an ERV value minus a realtor's fee, minus holding costs, minus title fees, my profit. And my big thing that's missing in there, okay, my profit, let's say I'm 20%. How much of that 20% do I actually get to keep? That's my big uncertainty in trying to evaluate how much money I'm actually going to make, and especially if I'm doing a wholesale deal where I'm going to flip immediately. Do I have to pay capital gains taxes on things like that?
Okay, 2 questions in there. Let me repeat this for everybody. First of all, he's doing some fix and flips and rehabs. He's got all of his costs into his little spreadsheet, buys a property, fixes up, sells it. Let's say he makes 100 grand. Now that may have been a 20% margin, or maybe he makes 50 grand. Whatever the percentage of margin is, I don't care. How much did you make? He says, I make 100 grand on this deal. That's great. So his first question is what percentage of that should I be setting aside for taxes in my equation? My standard answer is it just a starting point for clients, is 25%. Take 20 to 25%, just carve it out, and just put it in a savings account and forget about it. Now, there are going to be variables. If you're a real estate professional and you got a bunch of rentals, your tax rate could be much lower. Depending on your tax bracket, that 25% could need to be higher. Is it subject to self-employment tax? I don't know. So there's some variables, but if you're setting aside 25%, that's going to keep you out of hot water and give me plenty to work with on your tax return. So anybody that's kind of estimating profit from projects you're doing, look at what your draws are and take about 25% and set it aside. So if this gentleman in the back nets 30 in a given quarter, or he's netting 10 grand a month, take 2,500 a month, set it aside, and live on 7,500. Now maybe we can even carve out an extra 1,000 for some savings, but at least 25% would go to taxes. You're in a different state, you're in a different bracket, it would vary. But let me throw this out too. Let's say you put aside the 25%, you don't need it. There's our down payment for our next rental property, right? So we're setting aside money, and if we don't use it for taxes, I'm sure you'll have plans for it. His second question is, well, say, Mark, I made 100 grand in profit, but I took it and bought another property. That's got to be a write-off, right? I mean, I'm not going to pay taxes on the 100 grand. I just flipped it into another property. No, because when you buy a new rehab, it's a carrying cost until you sell it. So you just bought basis in something new. So the 100 grand flows through to you, whether it's an S-Corp, an LLC, or whatever. You're going to pay the tax on the 100, even though you buried it in a new property. Now, once you pay that tax, you've got after-tax profit sitting in that new property, which is great. So when you sell the next property, you're going to get that 75 grand or 100 grand back tax-free, and any extra money you put in. So you're building that. A good way to think about it for rehabbers, I don't say it this way very often, is you want to be building that after-tax investment pool of money. And as you do more and more rehabs and pay the tax on the profit as you're going, pretty soon you got this chunk of money you're just using yourself instead of hard money in other places to just roll that money to the next one. But the profit has to be captured on each deal. So great question.
Okay.
I hope that helps. Yes?
I'm quite different. I have a day job, W-2.
Okay.
And then I do real estate on the side.
Ooh, I like it. We're going to move
to mix the two. Is there a way to reduce the W-2 taxes?
Oh, man. You just turned me on. Sorry. Oh, my gosh. Woo! Okay. Now, because it's... Well, sorry. All right. So, okay, since it's 8:15 and time's flying, I'm going to jump to another topic. If you want to learn more about the S-Corp, I've got little S-Corp videos in my tax and legal library section of my book. I compare the S-Corp to C-Corps, so you can learn more about it. We've got a big event at the end of this month too. I'll mention that it's for a full day, and I think you'll find that to be another resource. It'll be affordable. So don't be upset as I move to another topic. Okay, so my fine sir, here's what you're going to love. And this is for everybody out there. One of the best ways to save taxes and shelter W-2 income as well is rental property. We've got to talk rentals. This is a whole chapter in my book, and I make the challenge, and I want to make this challenge to all of you, to try to buy one rental a year. Now let me throw that out again. Just put your guard down. I want to try to sell this to you. And by the way, I'm not a licensed realtor. I don't have a list of properties to sell you tonight. So let me just say, as your accountant, I need you to buy one rental a year. Now, so you don't want to buy a rental a year, right? You got a big fat 401k. Someone's matching it 100%. You got 400 or 500 grand in it, right? It's just rocking. Oh, you got Social Security, right? You don't look that old, but you're planning on Social Security, right? And it's going to pay big, right? Woo! It'll be there, right? Oh, you don't have a 401k or Social Security? Well, what's your retirement plan? I would encourage you to consider rental real estate. This is where it's at. Tax-free cash flow. Huge. So have an open mind for a minute. But you say, Mark, oh my gosh, you don't know. You don't live in San Diego County. Try to buy a rental down here? It sucks. You kidding me? I don't have an extra 200 or 300 grand laying around. I'm even renting myself. Shouldn't I buy my own house first? Sometimes it's cheaper to rent and invest in rentals than to buy your own house and suck all that capital into a house where you're not using the capital. I live in Orange County. You think it's easy up there either? And I share this from this personal note from the stage. My wife probably hates it sometimes. I'm renting. I rent in Orange County. I don't want to go dump 200 grand into the house I'm living in now just so I can buy it, when I can take that 200 grand and buy 4 rentals in Atlanta right now. The cash flow and pay my rent for me. And I'm building equity. Oh, but Grandpa and Grandma taught me I got to buy my own house and I got to pay it off. That's cool. Just that money's not working for you. It's a house. That's cool. Maybe there's a time where you have a house that's paid for, but Maybe there's a time to build some wealth. Okay, but Mark, there's nothing to buy in San Diego. Fine. Guys, the United States is our oyster. We're one Southwest flight and a Hampton Inn stay away from checking on our rental. Seriously. Seriously, you know you could be in any freaking city tomorrow afternoon for $300 or $400 and sleeping in a Motel 6 to check on your rental. Is that the end of the world? When you're going to invest $10, $20, $30, $100,000 in rentals to be able to go kick the tires on a rental, that's not a big deal. I do a radio show every 8 months at least. It's not even once a year. I do it more frequent than that. How to manage your property manager. Not how to manage your rental. How to manage the people that are managing your rentals. And there's an art to it, I agree. But you don't have to have a rental down the street to freaking start investing in rental real estate. Next. Some of you say, well, Mark, I don't even have a down payment. Are you kidding me? I can't buy freaking rentals. I don't even have a down payment. I don't care if it's in freaking Oklahoma. Guys, there are incredible no money down strategies. I've got no money down resources. We're going to have a no money down resource at our event later this month, where you can buy rentals around the country, well, I should say, in certain pockets, with no money down if you've got the credit. And there's creative acquisition strategies. Subject twos, lease options, estate closings. Oh my gosh, there's so many ways to get into a rental property. One of the speakers at the Renatus Academy or school that Daryl Nannerman brought up is Renatus is Chris Albin. And incredible. I just sit in the back of the room and just soak up his crap, right? I mean, it's just crazy. He's a school teacher in Chicago, and he's probably rolling in it. He was middle school, so they pay big. And so, just living the high life, right? He bought 300 rental properties on a school teacher's budget over the last 15 years. 300 rentals! Now, he's an animal. And he comes on my radio show. He's been on every year for the last 3 years on 5 ways to buy a rental with bad credit and no cash. He gets on it. He goes, Mark, I do this every day. I bought a rental from him 4 years ago. It's the sweetest little meth lab. It is adorable. I mean, they pay cash in a bag every week, and the renters are so nice. They're just amazing people. They really don't come out much, and it's great. But no, I'm not kidding. He was doing a property tour. I don't know if you know this, Kendall. He was doing a property tour with a little van, and he was showing some people some properties. And someone was in the car that was a client of mine. They're like, hey, can you drive us by Mark's property? He's like, well, it's daylight. I guess we could, And he pulled onto my street, and there was police tape and like 3 cop cars on my street. And he's like, well, not today. But I'm dead serious. I've had a Section 8 renter in there for the last 4 or 5 years. Rent every month by the gov. Boom, boom, cash flowing. Wait till you tell you how I own it too. We'll get to that. But anyway, so don't think you have to be rich. Don't think you have to have a rental down the street. And don't think it's too late. Get started and be thinking about rental. Oh, and one last thought, and then I'm going to show you how the numbers work. By fine sir, you open the can of worms, so I'm going to throw down. This year I had a couple of incredible radio shows on, I'm selfish. I schedule radio shows on topics I want to learn about, but I had a mobile home radio show. It was awesome. Do you know the average mobile home cash flows 30%? The average mobile home in the Southeast costs about 10 to 15 grand. It's crazy. 10 to 15 grand, they're cash flowing around 3 grand to 3,500 a year. Within 3 years, it's paid for. And the beauty is, if a tornado hits, you get a brand new mobile home. It's freaking awesome. So I just love it. And so now they're not appreciating, but these are little cash cows. Little cash cows. I was so excited. When I was at a speaking event down in the South this summer, or fall, I took my son, and we were in Arkansas, and I'm like, there's another mobile home park. And I was like, I got to check this out. My son's like, what are we doing in here? And it's like guns are going off. And dogs, and I'm just like, look at that mobile home, it's so adorable, some guy's out there in a, lawn chair with a beer, hey, what's up, and I'm like, that's my renter, I love that guy. And, man, I was like, that's my perfect renter right there, just sit by a mobile home, just write me a check every month. Oh, man. So my goal was to buy some mobile homes this last year. I didn't do it. This year I'm going to do it. I want to buy at least 3 mobile homes. But I got commercial properties, I got some duplexes, okay, we'll talk more. Okay, so here's the numbers. Okay, pay attention. Are you texting? This is important. Okay, all right. Now I was off on a tangent, but I was selling everybody. You're already on board. They weren't. Okay, all right, okay. Now there's 4 benefits to rental real estate. Now I know some of you have seen my 4 quadrants. It's a chapter in my book. But let's go over it for a minute. Appreciation, mortgage reduction. Oh, love that. Tax savings, the sexy part, and cash flow. Now these are from an accountant's perspective, these are the 4 benefits to rental real estate. And I want to run through some numbers. I'll see if my math works. I sometimes screw this up. So let's say you go buy a rental for 100 grand, fair market value, and you put down 10%. All right, so I'm doing it, 10K. Chris Albin would say you put down too much. Yeah, I'm not running to Fannie Mae for a loan. I'm just getting my freaking rental. So I got a mortgage for 90, but I'm getting 5% appreciation. Now some of you living in San Diego might go, Mark, oh my gosh, weren't you here in 08? Man, it was like minus 30. Yeah, but you know, for the 3 years before that, it was plus 30, right? We're going to see an average in the National Association of Realtors on their website, 6.74% national appreciation rate, average across the country over the last 50 years. It's outperformed Wall Street and the S&P 500. We know that if I buy a rental in San Diego for 100 grand, if I could find one, 10 years from now it's going to be worth 150, right? 5% appreciation is not off the chart. Now, am I getting the 5% on my 10 grand, or am I getting it on the 100? I'm getting it on the 100. So I just made 5 grand on a $10,000 investment. Power of leverage. One of the benefits of rental real estate. So I put down 10, I made 5. What's my ROI in my first quadrant? 50%. And I may never pay tax on that. I could do a 1031 exchange. I could do a charitable remainder trust. We don't have time for that tonight, a whole hour presentation. We could do installment sale, another topic I love to talk about. One of the best tax strategies is dying. You get stepped up basis. I try to talk clients into that. They don't buy in. It's sweet. The kids buy in, but mom and dad don't. So huge, huge. Okay, so we're getting 5 grand appreciation tax-free in the first year. Okay, so then mortgage reduction. Now, we know it's going to be mostly interest in the payment initially, but let's say even I get a couple $100 a month or close to it. So I get $2,000 in mortgage reduction. Now, who's paying the mortgage for me? Are you paying the mortgage? No, your tenant is. Now, when I buy rentals, and this is what you'll learn in Chris Albin's class, is that you want PITI. That's how you analyze your rentals. That's the starting point. There's a bigger spreadsheet, and I'm sure, sir, you have a bigger spreadsheet than that. But what does PITI stand for? Ooh, boy, Emron and Aaron, you got your, sorry, Emron and Aaron. I have 2 cousins named Emron and Aaron, so Daryl and Emron, it always screws me up, sorry, forgive me. Okay, so principal, and then interest, and then what's T? Taxes, and insurance. So there's my basic mortgage payment, right? Bundled up, nice and pretty. If my tenant can at least cover PITI, that's a break-even property. Anybody have a break-even rental out there? Oh my gosh, they exist, right? So I'm covering at least PITI. So the tenant's paying the mortgage for you. So look what's happening. If my mortgage goes down by 2 grand a year, the property's going up in value by 5, the mortgage is going down by 2, I just built 7 grand of equity tax-free. I'm building equity, and I didn't take any more money out of my pocket. I leveraged my 10, and I just made 7. So in this quadrant, what's my ROI? 20%. Woo! Now the sexy part, taxes. Okay, now this is where this gentleman was heading us to. You know, Mark, I want some tax write-offs, damn it. All right, chill out. Okay. Now, this renter's paying the rent for you, but you don't get to write off the interest because they paid the rent, right? They paid the mortgage? Or do you get to write off the mortgage interest? Yes, you do. What are those big write-offs that really your rental is going to lose money on paper? Why is that? What are you writing off? Interest? Depreciation. You're writing off the value of that building over time. It's a non-cash deduction. You're not having to pay for it. You're using the bank's money to get a depreciation deduction. Oh, okay. Sorry, okay. So you get to write off depreciation, interest, cell phone, dining, travel, entertainment, property taxes, insurance, cell phones. I'm writing off all those personal conversion expenses to support my rental. All of a sudden, my rental's losing money on paper. one of my rentals that I'm so proud of. Not even my meth lab in Chicago matches the power of this. But I bought a duplex right next to my mother-in-law. It was ingenious. It was like discovering plutonium. So I bought a duplex in Idaho. I don't want to go to Idaho. I hate going to Idaho. But every time I go to visit my mother-in-law, I now get a tax write-off to check on my rental. And I take my team of employees, my kids, with me to go work on the rental. It's incredible. They now hate going to grandma's because they have to work on the rental. It's like produced this side benefit that's incredible. So, I love you, Gwen. Sorry, that's my mother-in-law. I don't know why I'm looking up. She's still alive, but because she haunts me. She haunts me. So anyway, travel. Oh my gosh, we could do I've got a whole video just on travel. But I love travel deductions because they're one of the most underutilized write-offs for small businesses. I want you to find a reason to check on your rental. I want you to do your corporate meeting. I want you to meet with a vendor. I want you to meet with a customer. I want you to take a class. Guys, when I'm teaching my next class in Hawaii, come on over. Take a tax write-off to come to Hawaii. Let's meet at the office and go over your taxes for the year. I don't know. Every trip you make should be a tax deduction. That's 100%. Dining and entertainment's 50%. This is where rentals can really pay off with a great travel write-off. Anyway, so I'll say this year we're going to do over, 2,000 rental properties because we have so many. I have clients with 40, 50 rentals. And the average rental on our books of all of our clients, the average, and you can talk to CPAs about this, is around $8,000. The average rental will lose on paper $8,000, even though it's cash flowing. Even though it's cash flowing. I'll be conservative. Let's say $6,000. Mark, it's not going to be that good. So I get a $6,000 write-off. My AGI goes down by $6,000. If I'm in a 30% bracket, how much should I save in tax? $2,000. Now we'll get to how to do this in a minute. But if I'm able to write off this $6,000, I just saved $2,000 in taxes. I'm paying $2,000 less in tax because I bought a rental that only cost me $10,000 to do, which Chris Alvin would have said you spent too much to do. So, 20% ROI. Saved $2,000, invested $10,000. Cash flow. Anybody got a property cash flow is $100 a month? $200 a month? $300, $400? I got this little piece of crap rental, this beautiful little rental in Phoenix. It's a 1-bedroom bath condo, 1 level. It's part of a quadrant of 4 of them. And it's got a rock yard with a cactus out front. My maintenance is about $100 a year. It's terrible. And property taxes are $600 a year, so it's $50 a month. And I bought it for $19,500. Now this was in 09, 08, when it was like crazy, right? It's worth about $35 now. I think I just got the property tax notice, so it's up $15,000. Have had it about 6 years now. And my renter pays $550 a month for a little $19,000 piece of crap. These do not have to be San Diego $300,000 rentals, guys. These could be just little rentals you pick up where your grandma lives, your aunt, your uncle, your brother, your sister. Oh, your brother's in the military up in Seattle. Oh my gosh, I got a contact up in Seattle. He's got rentals coming, most incredible cash flow rentals because of the military bases up there. He only exclusively deals in military housing. Incredible niche. What? Tomato. So let's just say you cash flow $100. Cash flow $100 a month. Let's say it's 90 and you cash flow $1,000 a year. $1,000 in cash you wouldn't have before to pay for your kid's cell phone. So you're going to use a personal expense that's now converted to a deduction. And do you pay tax on that $1,000? No. You're paying no tax because you got a loss. You just produced tax-free cash flow, which is another rate of return. So if I produced $1,000 of cash flow, $2,000 in tax savings, $5,000 in appreciation, $2,000 in mortgage reduction, that's a 10% ROI here, 20, 30, what was this over here? 20, there's 50 plus my 50, I made 100%. I made 100% in this one little crappy rental. And this is a conservative example. This is a conservative example. Now you may not get all 4 quadrants. You may have higher appreciation one year. You may have kind of crappy cash flow one year. You might get mortgage reduction one year, and certainly in later years it could be more. But as you look at this model and you build your spreadsheet and start analyzing your rentals, and this is what Chris Alvin says. He goes, Mark, you're not buying properties. You're not buying rentals. You're buying numbers. Did the numbers make sense? Oh, you think this is too aggressive. All right, let's cut it in half. 50%. I know your mortgage, I'm sorry, I know your stockbroker's making you at least 50% on your stocks. So right? So I know, so. Guys, this is crazy. Now before I focus on this tax thing for a minute, when we go to analyze our rentals, I want to highlight this. Rentals have risk. Rentals take work. I know that. But they take some education. That's why Daryl and Emron are talking about Renatus. That's why I'm one of the speakers at Renatus. Darren and Kendall here, they both speak at Renatus. They're going to be at this event later this month. In fact, I think both you guys or Kendall are speaking next month here at the club. I may have you come up and share what you're going to be talking about next month. I'd love to have it. It takes some learning, and it's risky. I have bought myself some crappy rentals. I'm still learning. But you know what? I own 8 rental properties now. And guys, this is my retirement. And I'm hoping 10 years from now, I own 18 rentals. And I'm just getting started. I got 3 kids in college right now, so I'd be buying more rentals if I could. But this is for real. Now, here's one of the biggest mistakes. Back in 2005, 2006, 2007, what quadrant was driving everybody's acquisitions? Appreciation! We were all appreciation drunk, right? Oh, I'll buy another rental, I'll have another one. Yep. Yeah, Billy, I'll have another one. Yeah, bring it on over. I'll buy it. I don't care how much. Just bring it. And then all of a sudden the music stopped. Right? We got stuck with rentals we didn't want. Oh, like Mark bought a stupid ski in, ski out rental that did not cash flow at all, and it was a nightmare. Oh, and I gave it away. Which quadrant matters? Which quadrant tells us which rentals to buy? Cash flow. If they cash flow in a good market, they'll cash flow in a bad market. Rentals have gone up in value since the crash. Why is that? Why are rentals more valuable now than they were in 2006 and 7? Because there's more renters on the street because they lost their freaking houses, and you're there to take advantage. I mean, you're there to help them. Right? Sorry, I wanted to rephrase that. Okay. Okay, now, this gentleman here, I still have not answered his question. I've been building up to it. So he said, well, Mark, I got a W-2. I don't want to go out and build ordinary income. I don't want an S-Corp. I just want to buy rentals. And I want to save taxes on, and maybe you get the 3 quadrants. Maybe you get mortgage reduction, appreciation, and cash flow. Well, that's cool. Your quadrant still makes sense. You're still getting a great ROI. But wouldn't it be sweet if we could write those off against our other income? And if you live in San Diego, I know you got some income, right? We want to shelter it. I'm not talking to Arkansas residents. That's a whole other different speech. It's how to write off your sister and your extra wife, you know. Sorry, that was your wife. Sorry, anyway, get screwed up. Okay. So if you're over here with a W-2 and an S-Corp, the rentals are over on this side of the equation, right? And you've got your LLC, and you're buying your rentals, and I have a whole little thing on how many LLCs do we need. A whole other topic. Don't have time for it tonight. Can I take all these losses and write them off against my other income? That is the golden question. I'm sorry I've been writing from this angle here, but you're a CPA, you can get it. This is my best side anyway. Okay, now, so there's 3 classifications of a real estate investor. And if you screw it up on your tax return, and I know some of you are doing TurboTax right now because your accountant sucks and you've given up finding a good accountant. So you've just resorted to Turbo. I get it. But if you check the wrong box, you're SOL. And I'm talking statute of limitations. So number 1, if you check the wrong box, you could be passive. How many of these losses can you write off against your other income if you check the box that you're a passive investor? And you'd think you're passive, right? Because you've got a property manager, so I must be passive, so you check the box. How many of these losses can you write off against your other income? 0. Big donut. Nothing. Only against other passive income. And that's why you generate tax-free cash flow. I'm not opposed to that. That's cool. Tax-free cash flow. I'm good. But man, I want to write these off against my other income. So option 2. I could be I could be an active investor. An active investor gets to write off up to how much against my other income? I can write off how many losses? It's 25,000. I can write off up to 25 grand of losses against my other income. But it phases out. I make too much money, I'm hosed. So if my AGI exceeds 150 grand, I lose my write-offs, right? Or do I lose them? No. They go into a passive loss carry forward bucket. This bucket, oh, love this bucket. This bucket starts to grow. And you're building losses. And even though your income's high, and you may not get the write-off, they're going in the bucket. And some CPAs go, oh yeah, Bob, that Kohler, he's full of crap. You shouldn't buy rentals. You make too much money. You can't write it off. Did we forget the other 3 quadrants? But they'll also say, no, you don't need to write off your kids. Don't worry about writing off your travel to see your mother-in-law because you won't get the write-off. Oh, no, you'll get the write-off. It's just delayed gratification. All of those losses are going to go in this bucket. And here's what's cool. You never lose them. They never drop out. Only upon death do you lose your passive loss carryforwards. And what's cool is you could be getting these losses from property 1, 2, 3, 4, 5, and then 5 years from now, 7 years from now, I'm going to sell property 4. You can dump out any loss you want to wipe out the gain. So you can dump out all losses against any gain. Did you just get tingles? Praise the Lord. Woo! Is this spiritual or what? Oh man, this is a revelation. That's what it is. Okay, so I just used my losses to maybe avoid a 1031 exchange. Maybe an installment sale. I get to walk away with that profit tax. I can use those losses against depreciation, recapture, anything I want. So capture them. Don't be afraid to grab them. If you're a W-2 wage earner and you say, Mark, I want to save taxes, I'm going to save you taxes. Maybe it won't be this year. I'll come to that one. But maybe it's 5 years from now, 10 years from now. You're like, oh my gosh, I was buying rentals and I was tracking all those write-offs. I was writing off all that crap, all those kids and trips to grandma's and no. And I've got 300 grand sitting here in losses I pooled over the years. Start selling your rentals, wiping out the gains. Woo! That's what I'm saying. Okay, third option. If I'm a real estate professional, how much of these losses can I write off against my other income? All of them. Every year, 100%, no bucket. I can use them to wipe out my W-2 income. Refund! Can we say refund? This is huge. Now to qualify as a real estate professional, it's really a 3-part test, but primarily 2. Number one, you have to have your primary occupation has to be real estate. So I wrote primary. It may look a little ugly from the back row, sorry. But that's primary occupation. Now that doesn't mean you have to be a licensed realtor. Doesn't mean you have to be a licensed contractor. It just means that when you wake up in the morning, you do real estate. Now you could be a part-time pharmacist, but 20 hours a week, but you better darn well be doing real estate the other 21. Because that's your primary occupation, is doing real estate. Managing your rentals, doing your rehabs, doing your fix and flips. I don't care. Get licensed, not, whatever. Just show me that it's your primary income. Number 2, you've got to spend 750 hours a year doing it. So that's about 13 hours a week doing real estate. And if I'm doing 13 hours a week of doing it, see, some of you are like, well, Mark, I'm retired. Real estate's my primary activity. I got 1 rental. Okay. Well, I don't think you're doing 13 hours a week on that 1 rental in Oklahoma. It's not happening, right? So they really go hand in hand. It's doing enough work in your primary job. The third test is you're materially participating. There's actually 7 tests to show that you materially participate. I've been in IRS audits with clients that have come to me in this problem, and we've got around this. It's pretty easy, but it is a third aspect. Now here's what's cool, guys. And this is going to be the trick to your strategy. Because if you're a W-2, I doubt you're a real estate professional. But here's the cool part. If your spouse qualifies, you both qualify. So when your spouse is the real estate professional, all those rentals become 100% write-off against your W-2. I've got so many clients taking advantage of this. So my fine sir, are you married or single? Married? Is she a real estate professional? Do you love her? It's a big question. Not around April 15th, probably. Where are my single real estate professionals? This is huge. Any single look at this. I see a few. Look at these ladies right here. Single real estate professional. This is huge. Do you know her street value? This is huge. I mean, where's my W-2 guys? Where's my single W-2 guys? Come on. There's got to be a single W-2 guy out here. Oh, you're not raising your hand, right? Okay, he's out here. What's your phone number? What? I'm serious. I'm opening a website called taxmatch.com. And see, I love long walks on a beach. I'm a real estate professional, and I have an AGI of 135. Boom! This is huge. Oh, guys, no, but it is seriously a great strategy, and it may not be a get-rich-quick scheme this year, but the next year. But seriously, this gentleman here, does your wife have a W-2 day job too? Or okay, now you're buying rentals. This is a great opportunity to say, hey, honey, if I got hit by a bus tomorrow, what are you going to do? What's our retirement plan look like? We've got rentals already. I want to ramp us up to 8 to 10 to 12 rentals. Could we go to some education together? Could we go to a day class? Could we start watching some classes online? Let's just get educated on this. You can move at your own pace. Now, you can see I've tried to sell to my own wife on this. I've used all these arguments. Move at your own pace, learn at your own, and just start getting involved. And then together, she blossoms into a real estate professional. Maybe it's 1 year from now, maybe it's 3 years from now. But all of a sudden, those 8 to 10 rentals, you get the fourth quadrant. Bam! Just comes in the back door. Boom! So this is huge. And when you can work as a couple in this, for those that are married, for those that are single, I put some of my clients on dating restrictions. It's they're like, I can't believe I'm listening to my CPA who I can date. I'm like, have you seen your tax return? Okay, I believe you. All right. So it means something. Okay, so I've been talking way too much. So yes, thank you. Question.
I think the answer is probably no. But if in a given year you cross the threshold to become a professional, can you tap into any of that previous carryover money?
Gosh, I've been giving such good news tonight. But no, he says, and let me rephrase it for everybody. He says, Mark, I got this sweet bucket, and I just got married to a realtor. She's adorable. I'm in the money. Okay, the bucket's there for when you sell your next property. But any new losses, 100%. So, and that's okay. You'll get them, because you're going to sell a rental at some point. Thanks so much, Daryl. Yeah, great question. And thank you for letting me slow down for a minute. I've been talking way too much. Only in an hour and a half. I mean, I love to talk. I've got a 2-day class. I've got anyway, sorry. It's just fun. Is this fun? This pole, you just want to kind of wrap yourself around it. Some of you, it's a little bulky, but we can make it work. That's my pole dancing class. Yes. Okay.
Investors investing passively in syndication, or if they have multiple rental properties withdraw through syndication, which one is going to fall?
Well, that's going to be tough. So let me repeat his question. He says, Mark, we've been investing in real estate from truly more of a passive aspect. We've been doing syndications. We've been doing REITs. We're really hands-off. You would still qualify as an active investor. Active investor, I didn't mention this, is really easy. It just means I made a decision. I'm in charge. I mean, you've got to literally be almost in a coma or living on an island somewhere to be not active, in my book. All my clients are at least active. But to be a real estate professional, the problem you're going to have is in category 3. You may say, I do real estate full-time, and I do it 750 hours, but all my rentals and all my K1s for my syndications, all those losses, you don't materially participate. Because it's syndicated. You have nothing to do with it. And that's going to be real hard even under these 7 tests. What I do tell clients that are already in those types of deals is that if they're successful and you like your rates of return, leave them, but just don't do any more. Start adding some traditional rentals to the mix. Because those traditional rentals are going to really pay off. And this is where the mobile home strategy is huge on the cash flow quadrant, but low on appreciation. And we know, and we even know that the tax benefits of a mobile home are going to suck. I mean, you're really going to write the damn thing off so fast that you're going to have almost taxable income, which is okay. You're getting great ROI on your cash flow. This is why when you start investing in real estate, you start to get kind of a portfolio. You have a little commercial, little duplex, little college housing, little, military housing, maybe a couple mobile homes. Because as the market fluctuates, you want to be insulated. Some people go, well, Mark, I got a rental, and oh my gosh, what happens if they don't pay rent 1 month? Well, I've got 7 other renters that did. And so as you start, this is the cool part, seriously. The more rentals you buy, the less riskier it is. Because you're diversifying those empty rent months. Yes?
We own 2 rentals, and this year we made over $150,000, and so it limited the losses. At what point would it be safe to consider myself a real estate professional?
Okay. When it matters is, number one, when you have rentals. So when someone goes, oh, Mark, I loved your presentation. I better be a real estate professional. And I go, really? Tell me about your rentals. Well, I don't have any rentals. Well, then who cares? So, so the first thing she said, which is important, she goes, we have rentals. Okay, that's good. Number 2, you have losses and your income's over 150. See, I have some clients that they have rentals, but their income's under 150, they're getting their write-offs. Who cares? Don't be a real estate professional. So you're over 150, you do have rentals, and the losses are going in a bucket. So, frankly, as soon as we could make you a real estate professional, it would pay. However, you're like, Mark, I got a great day job. I'm a nurse down at the hospital, and I'm making some good money. These losses are nice, but I don't want to quit my job as a nurse. So there's a tipping point where it's too expensive not to be a real estate professional. And I've had clients that do that. They'll start to go part-time. They're on their 7th or 8th rental. Then they get to become 9 or 10 rentals, and then 12. And all of a sudden, it's like, I got to quit my job. Boom. Sorry. Oh, yeah, comment.
Exactly. I mean, Daryl and I were partners doing while I was working a full-time job for 2 years before it made sense for me to walk out. So.
And I like what Emran said here. Let me repeat something else, too. You'd be shocked. Maybe you wouldn't, but, I hope I don't offend anybody in the room that's maybe doing this or said this, but you'd be shocked how many people come to my office and they're like, Mark, I'm starting a small business. I just quit my job. And I'm like, oh, don't tell me that. I'm like, no. You keep your job until it's too expensive to go to it. Let's not do that. Let's buy those rentals on the side. Let's get that real estate joke. Now, what this does mean, you're going to be working your A off. That's right. You're going to be working nights. You're going to be working weekends. You're going to be at lunch hour doing all you can to keep up on your business until it's killing you. But so many people are like, well, I got to watch my shows. I mean, The Bachelor this week. Who's Chris going to choose? I mean, this is a big week, right? Who's voting for Brit? Huh? Anybody? This is The Bachelor. No one's watching The Bachelor. Who's my Bachelor fans? I know you're out there. Come on, ladies, right? It's down to Brett. It's down to Brit and not Ashley. Who's? Becca. No, it's Becca. It's Becca and Brittany. Whitney. It's Becca and Whitney. I was rooting for Carly. I thought Carly was adorable, but anyway. And so I have teenage daughters. I've got to do something with them, right? So we have our Bachelor. It's Monday night, Bachelor night. I just blew my entire image with many of you, didn't I? Sorry. But I was rooting for Chris. He's from Iowa. He was looking for a wife. And boy, when they went back to Iowa, eye-opener for some of these girls. But anyway, okay. So anyway, but what I was saying is, when you're starting your small business, you're going to have to make sacrifices. You can't watch The Bachelor on Monday nights. You're going to be working those hard hours. But that's not quit our job. So I like what you said, Emran. I think it's a good point.
That's true. It was like working 2 jobs for 2 years.
Yeah.
It was worth it.
So one of the questions I would have would be, for the people that don't really know how to invest in real estate, and they partner up with an operator who's very experienced at real estate, and they invest some of their money into, let's say, an LLC, what kind of tax write-offs do the investors get along with the operators, or is that too complicated right now?
So do they qualify as an active?
Would they qualify as getting a lot of the deductions or write-offs?
Well, let me
Or
answer that.
50% if it's a 50% partnership.
I can answer it. It's just a boring question.
Making money.
Gosh, I was more interested in Becca and Whitney, but all right. Okay. All right. My first question is, what kind of real estate is it? Short-term or long-term?
Long-term.
Long-term. Okay. So we're over here. We're in an LLC.
Yes.
And I'm going to partner with Daryl.
Yes.
And he's a real estate professional, and he's going to manage this LLC for me.
Yes.
And we're going to be out there. Now, we're typically going to, Daryl's over here with his S-Corp. Is his S-Corp going to have anything to do with the LLC? No. There's a wall. This is his fix and flip, rehab, commissions, real estate. This is the rentals. Now, Emron individually, Daryl may individually be the manager. We don't need to make his S-Corp the manager. I guess you could. You don't need it for asset protection, but maybe an extra layer for the hell of it. But, sorry, excuse me, for you BYU fans out there. But, okay, sorry. I'm a University of Ute, so a lot of BYU. There we go. BYU sucks. Woo! There we go. Okay. So typically what we have in this LLC is each of your trusts would be the owner. This is where the estate planning comes into play. I love to talk about estate planning and death. We won't have time about it tonight. So funny. Oh my gosh. My best jokes are here. Oh my gosh. Oh my gosh. I'm on a roll on this topic. It's so fun. If you had fun tonight, we got to start talking about dying. It's awesome. We've been doing pet estate planning. Pet estate planning. Is that, I mean, just right there, you know it's going to be a hoot, right? Literally today. Do you know one of the estate plans I drafted today? The only estate plan I did today was drafting for a cat. That's what I did. An estate plan for a cat. Here's what we drafted in this estate plan. I'm going to answer your question, I promise. Okay. I was drafting for this cat because she's so worried when she dies. See, what happens is, Grandma, you know, she dies, you know, and you have a wonderful funeral potatoes, the best potatoes ever at a funeral. And you're at this funeral and Grandma dies, and no offense to anybody that had a recent passing, I apologize, but you got to make light of this to talk about it. It's too tough of a topic not to. So anyway, Grandma dies, and then, you know, everybody gets back for potatoes at the house, and Fluffy's running around, you know? And everybody's like, well, who wants Fluffy? I don't want Fluffy. Who's going to take care of Fluffy? No, I don't want Fluffy. And all of a sudden everybody's like, you know, drawing straws of who's going to take Fluffy down to the pound, you know? So, you know, 3 hours later, Fluffy's down, you know, at the pound getting juiced up, you know? Grandma's up in heaven, just went through the pearly gates, and her dog comes running up to her. She's like, what the hell happened to you? He goes, I don't know, I was just running around. Everybody's eating. All of a sudden I'm up here, you know? You know? People worry about this. They worry about this, you know? So in our estate plan today, we drafted a guardian for the pet, and we're giving the guardian we had a conference call about this. I'm at $400 an hour, you know, and I had a conference call on this. And we had a call. By the way, it's worth every dime. I don't want you to not think it is. I'll save you 10 or 20 times that, I promise. This time I was saving Fluffy's life. It was worth it. I was. So she goes, well, why don't we just leave 20 grand for my guardian? I just want her to take care of Fluffy. And I go, well, what happens if Fluffy mysteriously gets ran over by a car next week? And she goes, no, she wouldn't. And I go, you never know. And she goes, oh my gosh, Mark, you're right. What do you recommend? I go, let's do this. And this is my standard recommendation. Let's give her $5 grand a year for every year Fluffy lives. And then you know that she's going to take care of the dog or she doesn't get her $5K. She's like, okay, let's do it. So we drafted it then and there. We put together a little budget for the trustee that the money goes on a regular basis to this guardian until the pet dies, and then any extra money goes to the beneficiaries. And so I think this is classic because on December 31st, he's going to be on his last leg and someone's going to be giving him, you know, CPR. Come on, you can make it. Come on, I need that $5 grand. Come on, just 3 more hours, you know. You know, and they're giving Fluffy mouth to mouth, you know. But that's what she wants, you know. So anyway, okay, Daryl, where was? Okay, sorry. On the pet question on the pet.
Yeah.
Okay.
About 20 Fluffies, right?
Yeah. If you're volunteering as a pet guardian, dude, that would be sweet. Well, one of my clients left their money to it was like an animal shelter, but it wasn't like a shelter where, you know, you check in but you don't check out type of shelter. Ooh, that's classic. I've never said that before. That was good. Got a note to self on that one. Okay, anyway, see, I'm looking for new material. This is where it's at. Okay, anyway, so Daryl says, I'm going to invest with him. I'm passive. I'm a tax attorney. My wife's not a real estate professional. So am I passive or am I active? That's the question. So Daryl's over here in his trust, where his investment ownership goes. See, everything you own, I want it to go down into your trust. Daryl's trust owns his S-Corp. It owns his home. It owns his LLCs, his IRA, 401ks. Everything goes down into his revocable living trust with his pet provisions. And then it all flows down in here. But this is his 1040. So to answer Daryl's question, the determination as to whether these losses are passive, active, or professional are made at the investor level, not the LLC level. So you may get real estate professional ordinary deductions. I may be stuck in passive or active. And so it depends on where the investor's at in their personal life as to how the K1's treated.
Okay, I think maybe I was asking does the LLC get the 4 quadrant?
Oh my gosh, yeah, we're buying rentals up under here, appreciation and mortgage reduction and cash flow and la la la. And I may be getting tax-free cash flow and I'm building appreciation. And so as an investor, I may want to partner with the Daryl when I'm just learning the ropes. Totally cool, yeah, love it. But from the tax benefit, my tax benefits may be limited versus yours depending on which investors in which category.
But they are split up at the level of the LLC. But they still get the difference.
Yeah, and before on this question too, yes? Go ahead, sorry. I want to bring Daryl, you got to come up here for a minute because I'm going to do a demonstration. This is going to be good. Okay. No, this is going to be good. Okay, go ahead.
So why do you want everything to flow into trust? It seems like the S-Corp and the LLC and the trust would all be separately protecting whatever they're protecting.
Well, yeah, you said it right. I want the S-Corp to, see, the S-Corp shouldn't own anything. I mean, I may be doing rehabs and fix and flips, but the S-Corp's a shell. If you want to sue my S-Corp, great, you can have my cell phone. There's nothing in it. That's it. But the LLC is where my assets are at. I may have an LLC with 5 rentals here, an LLC with 3 rentals here, an LLC in Georgia, an LLC in Texas, an LLC in Utah. So I've got my assets here. And so I've got asset protection. I've got passive versus ordinary. But the third leg of the stool is, what about if I get hit by a truck? Where's the estate plan? The trust owns everything, not you. So if you passed away tomorrow, everything goes into the trust, no probate, no estate tax, divvied out to the family members, and all that asset protection that you were going for is coordinated as a family so you don't have to pay out a ton of money to lawyers and there's no fighting with the family. So there's not a tax purpose to the trust, it's a keep my life and my family together purpose.
So if you have an S-Corp for your business and you have a trust, your trust should be the rest.
Depending on how substantial the S-Corp is, yeah, why not? Now, I mean, by default, I don't want to overstate this, but if you were to pass away tomorrow and you're the owner of your S-Corp, okay, to take control of the S-Corp, we might have to file documents at the state. We might need, who's going to be the president, secretary, officer, director? Do you have other board members? I don't know. Are you married or single? But if your trust is the owner, your trust steps in, your trustee. Collects accounts receivable, pays the bills, shuts it down. Or maybe there's a rehabbing process, closes up the deal. So it makes it simpler. You don't have to, but the IRS treats a revocable living trust as a defective grantor trust for S-Corp purposes. Some people say, well, a trust can't own an S-Corp. But no, a trust can if it's a grantor trust, meaning it's defective, meaning there's no tax return at the trust level, it just flows to you. So it's kind of an estate planning technique. It's kind of sweet. So, oh wow, all these hands. Okay, I'm going to go boom, boom, boom. First, yes.
And does it become beneficial to have a series LLC with rentals?
Oh, jeez. Okay, what was your question back here? Okay. Okay, you know what? When I left the office at 5 o'clock, because I had to hit the printer and I was running down here. Can we go to 9:15? Is that okay?
Yeah, as long as everybody's good with it.
I'm so sorry. I won't keep you much later than that. But
maybe repeat the question because we probably didn't.
Okay, so he said, when would you use a series LLC? So at 5 o'clock today, I was setting up a series LLC in Illinois. It's a client that has about 8 rentals. Okay, I'm just going to hit the highlights. I encourage many of you for some extra. Again, I'm not trying to be salesy here, but there's so much here with my little tax and legal videos and also our workshop at the end of the month where you can get some more on this. So I'm sorry, I'll be brief. There's really three ways to divide up your rentals. You could have one LLC and put all your rentals in it. Now, this could be an LLC registered in California, Utah, and Nevada, and you've got rentals in all 3 states, whatever. Or you could have 3 LLCs, a Utah LLC, a California LLC, and a Nevada LLC, and I got a rental here, a couple rentals here, a couple different. What's the benefit of this one? One LLC, simpler, easier, one checkbook, one tax return, boom. What's the problem?
Liability.
Yeah, all my eggs are in one basket. If my little meth lab in Nevada blows up, all the other rentals are screwed, right? So I may not want to put all my eggs in one basket. Here, I got separation, but then I got the cost of 3 LLCs. The best of all worlds is a series LLC, where you have a parent LLC, and it can have baby subs, sub 1, sub 2, sub 3, and you can have as many subs as you want. They can hold a rental or 2 or 3, and the beauty is, in the states that allow for a series LLC, you only pay for 1 filing, 1 tax return, 1 tax ID number, and you can set up babies all you want. Now, we would love to do this in California, and California says, please come do a series LLC in our state, because we're going to hit you for $800, $800, $800, $800. Series LLC is not good in California. And I get, again, these fly-by-night sales companies that are trying to sell this on the web. And again, folks, please, this is why I say, I'm just going to say this, we charge $800 for a full service entity, $400 for a paralegal setup. I mean, you don't need to talk to a lawyer, just get it done. It's cheaper than LegalZoom. Please don't think that going and click, 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 and then figure it out later is going to save you money. Give us a shot to help you out with that. It can. I think I'm on a little flyer today. I even knock off $100 if you want to get an entity done, But just seriously, don't think you're cutting corners sometimes being online to do it. So in summary, let me just say this, and I'll come over to your question. I think you're asking about series. Is there's only 15 states that allow for series. Texas is the most recent one that allows for them. It's a table in the back of my book. You can go through and look at those states. Some of the western states: Utah, Nevada, Oklahoma, South Dakota. New Mexico, but we won't use it in California.
So to set up in those states, you have to do a foreign registry if you're doing it in California.
Okay, so in California, as you know, if you're the manager of the LLC, you need to register it foreign in California, even though you don't own rentals in California, which sucks. Now, some people play games with that. They'll have an out-of-state address and that sort of thing. I'm fine, whatever, just don't get caught. But if you register the series LLC in California, as a foreign entity, I'm only going to have you pay the $800 once. Now, if you tried to use the subs in California, then you're going to end up paying $800 more and more. But these may all be in Oklahoma, and it's an Oklahoma LLC, but we register it foreign, just the parent in California. Great question.
I'll get back to Daryl's question there.
Oh, hold on, before you say that, anything else on series here for a quick second? Okay, go ahead. Sorry.
We're picking up on the mobile home park.
Woo! Now, are you boning the mobile homes or the park?
Actually, it comes with 42 homes, and they were rental, we're going to sell them to the tenant. I don't want to own them.
Let me know. I'm interested. What part of Montana?
No, this is in Memphis.
I thought you said Montana. Memphis. Okay, cool.
So, question is, because there's 5 partners jumping into this thing, and their question to me today was, how are we going to break the taxes out on this thing? Okay, they're all coming in with different amounts,
Okay.
right? We're going to be a managing member. And, if this is a too long a question, I'll call you.
No.
But I mean...
Yeah, this is good. I didn't mean to walk away like I was pissed off or anything. I was just sitting here. Okay. All right, let me just say this in general. Guys, whenever you partner with even one person, it's time to set up an LLC and do it right.
It's an LLC.
Excellent.
Okay.
And it would be a Tennessee LLC. Also, you want to make sure you make the PST exemption application, because there's a Tennessee tax if it's not owned by individuals. So you got to be careful there. Individually owned Tennessee, there's a special election. So I don't know, you got to do it upon formation. So hopefully you already called the Kohler firm, because we would have done it right for you. I'm just saying. Okay, but let me just say this. So you'd have a Tennessee LLC. In the operating agreement, there's 3 levels of ownership. There's profit, loss, and capital. And you can play with those ownership percentages. Depending on who puts in what money, it can say who gets what. Some person may get cash flow, or you share everything 20, 20, 20, 20. Someone gets 10, someone gets 15. If you have IRAs involved, it's going to need to be pro rata. So you may have different IRA owners in that LLC. One of the topics we don't even get to tonight is self-directing an LLC. So if you set up the LLC and it has individuals as well as IRA partners, the operating agreement's just going to define all that. It's really quite simple. I had a conference call this morning setting up an entity with 5 different partners. It's actually a California entity, and we were just trying to figure out the percentages. I had 2 brothers I sent off yesterday to go tell me what your percentages are with dad and 2 sons. So you just define percentages typically by capital contributed unless someone's doing services, and then you just figure it out. Pretty straightforward. With the one LLC that I own in Chicago, let me just blow your mind here. We didn't have time to get into it tonight. The LLC that I have in Illinois that owns my little meth lab, not kidding, I don't own it. I don't even have my trust own it. My health savings account owns my LLC. So my HSA that I put contributions into every year for my health care, invested in the rental, and all the cash flow goes into my HSA, well, into my LLC, and I can pay for my family's health care and never taxes tax-free. And you can set up an woo, yeah, thank you. So the HSA just paid for Molly's glasses and braces. She's 11 years old. She got double whammied, and she feels like life is crushing her right now. Okay, yes, sir.
This is about an HSA.
Oh.
If I wanted to, if I started a small business and then I quit my job, could I roll my IRA over into an HSA?
You have a one-time IRA rollover exemption into an HSA up to the HSA contribution amount, which this year is 62-ish, 6250, 6300 if you're married or family, and if you're single, it's around 3500 or something. The numbers are constantly changing. So, but you're 35 to 65, 32 to 65 range. So you could roll some money into that HSA. Now here's the key. It's not so much if you're a small business owner or employed or unemployed or whatever. The qualification to have a health savings account is you must have a high deductible health care plan. Now under the metal plans, the bronze, silver, gold, and platinum, you need to be in the bronze range where it's higher deductible, premiums are lower, and you're going to self-insure yourself by funding the HSA. Now to kickstart it, you may roll $5,000 over from your IRA. $5,000 is all Chris Alvin needs to get you into a rental. Now your HSA owns a rental property and cash flow is coming out to pay for your health care. Oh, and here's your this is your HSA. Oh, this is Daryl's and MasterCard HSA. I have 2 HSAs as well. One that owns a rental, one that's at Wells Fargo. So here's Daryl's. It's a MasterCard HSA, account number 52440. So now if you don't use your HSA, do you lose it? No. It grows to next year, the next year, the next year. And just so powerful.
Learned it from you, Mark.
Woo! Thank you. Okay, 2 more questions, and then I'm going to start. Oh, 3. Okay, this is it, and then we're going to wrap up the evening with a couple major points. Yes, ladies first.
If you have an S-Corp that's suspended,
Okay.
how do you get that undone?
Cleaned up.
Yeah.
Tell your friend. I'm sure it's not you. Okay. No, and it's in California. Okay, so if you have an entity, some of you may have not paid your filing fees or paid your taxes on it, the $800, it'll go into a suspension. First, in California, in order to unsuspend it and get it up to date clean, you have to pay the old taxes. Now, the Franchise Tax Board is not coming personally after owners of S-Corps right now for those back taxes. If the entity is operating, they will go after the bank account of the entity. But if the entity is dormant or closed, they'll leave alone the owners. So if you've got 2 to 3 years of back taxes on this thing and it's suspended, let the damn thing go. Let's go set up something fresh and new. Yeah.
I need to do LLC anyway because I don't have enough to do that.
Fair enough. But second point, but determine what it is, you know. Figure out what the cost would be. Number 2 is the cleanup, and then doing the suspension is quite easy. You just file a new form and pay probably $100. See, the Secretary of State and the Franchise Tax Board are 2 different issues. Secretary of State, they welcome you with open arms. Send us a form and $100, we'll take care of you. Oh, but go take care of the Franchise Tax Board first. So that's where that kills you. But if you want to have someone run the numbers quickly, there's no cost. Call my paralegal, Susan Cumpy. Susan Kumpe, K-U-M-P-E. I know you want to say Kump, but Susan is our cleanup girl. It's crazy. We have a full-time paralegal. All she does is our LegalZoom cleanup service. Literally. It's fixmylegalzoomentity.com service, because everybody's like, oh, I didn't do this. All I got is one sheet of paper. That's my LLC. Doesn't count. We need an operator. We need minutes. We need a book. We need la 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 la. And everybody's like, well, I thought just an LLC was a piece of paper. No. Go to court with that. Good luck. Right? I mean, everybody says, oh, that's all you need. You know, Robert Shapiro, $99. No. So call Susan. She can run it through the state quickly and find an answer for you. Okay, over here.
Back to a long-term question involving multiple entities. Explain the tax advantage between owning a business like a retail business that would own the brick and mortar and the business versus the business that is the entity that would own the brick and mortar and an entity that would be the renter that pays the entity that owns the brick and mortar.
Oh, okay. So let me repeat his question. He just said, Mark, repeat the dentist versus dentist building, dental building. So it's very common. I'll use me as an example. We had our law firm in Cedar City, Utah. Woohoo! You know, and then my wife said, I can't go to Walmart for everything for the rest of my life, so we moved to the happiest place on earth, near Disneyland. And so we have an S-Corp for our law firm. Well, okay, let me expand it a little further. I'm an S-Corp, my partner's an S-Corp, and we have an LLC for the law firm. See, if I'm going to partner with Kendall on some real estate deals short term, I'm going to funnel my money through my S-Corp, he's going to funnel his money through his S-Corp, and we have an LLC for the operations. So I've got my S-Corp thing going over here. Do we own our building? Nope. Well, about 4 years ago in Cedar City, we said, we better buy our own freaking building and start paying rent to ourselves. So we formed a company over here, XYZ, and XYZ owns the building, and we pay rent to that LLC for the use of that building. And we have a firewall of asset protection now, so if someone slips and falls, like we got 36 inches of snow in the last week and a half in Cedar City, if anybody slips and falls on the way in, they've got to deal with the building HOA, the building owner, the LLC creates protection. They can't come after the law firm, we're just a tenant. We don't own the building, we're just a tenant. So down here is where the ownership could vary and blah, 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 blah. So this is very common. It creates a great tax benefit because we want a rent deduction and then passive income over here and blah, blah, blah. So does that help? We're good? One last question here, yes?
So we took over a title on that property subject to a few years back.
Oh, what kind of property?
Rental property.
Oh, rental, okay.
Yeah, subject to. We had a certain time frame before we had to refinance it into our needs. So that just happened recently. It took a while to find a lender that would actually do that in the first place.
Now you're going to pop it in an LLC.
Well, it was an LLC. We took it over.
Took it out, refied.
Yes, but how do we, now
Get-
it's in our name.
get it back.
How do we get it back to the LLC?
What state?
And we, California here, and it's in part of our contract, we signed just because it's the only mortgage company we can find that would allow us to do this. We signed saying that we cannot
Transfer.
title.
So it's a private lender? Or is it private money? Or have they already sold your mortgage to 9 different people and you don't know? Probably sold it. Okay. Well, my first, I literally was talking to one of my clients, he's a banker, and a lawyer for a bank. And I was asking him in a hot tub the other day too, because, let me give you my answer. Yeah, sorry. We'll come back to the hot tub. Okay. But anyway, here's the thing. You just transfer it. Don't worry about the due on sale clause. In 12 years, I've never had a client ever be called, have a due on sale clause. Now, I know someone may have a horror story. One second, let me just say
It's not a horror story. I was just going to say, he just did that when he took it subject to, probably violated that due on sale clause. I mean, we do the same thing, right? So now you've just become that owner that's doing it. So, I mean, kind of think of it the same way, right?
Well,
you know,
when you do a subject to, the underlying ownership is truly changing. And so that is a violation of the mortgage if they want to come after you, because they're like, what the hell, you still don't own it. But under most mortgages, that's my signal. Okay, 9:15, we're right on schedule. This is my last question too. But under most mortgages, if you're still the underlying owner and you're not in default, no bank's going to care. And this is what I was talking to my buddy that's a banker.
Here's how much they care. We did one last year where we actually had it was a small bank, and to bring, because it was in default, so we brought it current to take it subject to. We actually had to walk into the bank, and I talked to the bank manager, and he asked me straight out, "Are you guys just taking this subject to?" Right? And it had due on sale clause and everything, and he called me right on. I said, "Yeah." He said, "Okay."
Because they're just happy to have it paid.
Yeah. No, I brought it current, and I'm going to pay on it. They were cool with it.
So anyway, in general, you would do a grant deed, just deed it to your LLC. Worst case scenario, you have to deed it back. They get pissed. Okay, I'll deed it back. I mean, and rarely is a bank even going to know it happened because they've sold the mortgage 3 times anyway, and you're paying the mortgage, so they're not even going to look into it. So that's my general approach. Now, I want to mention a couple topics. I even have one up here. I'm not going to forget. This is good. It's good. Okay, now, by the way, so 2 or 3 things. First, I want to do a drawing for my book. You're going to love it. I'll sign it. It's worth a little bit more on eBay if I sign it for you. But so if anybody wants to be in a little drawing here for 2 seconds, and this will put you on my newsletter list. You can fall off, drop off later if you want. Every Tuesday you'll get a little email with my radio show, my blog. There's no cost for my newsletter, and I'll send you little updates when we're doing events or something like that. That's about it. So if you want to pull out a business card, I'll come down the aisle and grab them here in a second. Now, while we're doing that, I want Emran to come up and do a demonstration. You're going to have to help me. Come on, this is good. This is good. Okay, now I'm going to need everybody's participation here while you're pulling out your business card here. Okay.
Do I need to get a business?
No, this is good, dude. Okay, all right, so you can put that down. Okay, now I want you to face the crowd, and okay, you everybody have to say, okay, who he reminds. You got to do this first. You got to go. Okay, can you do that? Okay, who's he remind you of? No, come on, not Mark Kohler. Okay, do it one more time. Who is he? Okay, this is a famous movie star. No. Come on, do one more time. Okay, no, just do that. Come on, who is he? Come on, which actor is he? Sitcom. Jack, Will, and Grace. Come on. Am I not? Come on.
He's on American Idol right now. My brother from another mother.
Yeah. Dude, Casimir said that?
Yeah, all the time.
Do you? We had 60, 80 people here.
I've actually been to a Harry Connick concert, walking in with everybody looking at me, wanting to get autographs.
Really?
I'm not him. Yeah.
See? I wasn't crazy. Good job, guys. Come on. Okay. Let me play around. Okay, so here, help me go down there. This is for the drawing, so hand me your cards real quick. We'll do this, and then I want to just make a quick announcement.
If you don't have a card?
If you don't have a card, write, you know what? Write your name on the back of my card, if you need to. Write your name on there. I just want to, so here's a card of mine. I'm going to get these back. I don't know why I'm giving them to you, but whatever. Hand those direction, would you? Oh, here, I'll mention that right now. Here's an extra card if you want to write on that. I'll be right back. Did you need a card? No? Okay, here you go. Pass that down, could you? Thanks. Oh, there you go. Okay, oh my gosh. I got to grab a few more. Okay, if you're handing in cards, thank you. Guys, I appreciate it. I want to make sure that I can stay in touch with you. You need a card? There you go. I'll swing back by, write your name on it. Oh, write your email on it, or I can't freaking email you, because you want to get on my newsletter, right? So write your email on it. Anybody else have a card or anything? Want a card? You just want a card? There you go. I should grab a few more. I didn't know if you want. It looked like you were reaching in my front of my bag. Okay, thank you. Thank you. All right. Okay, I'll come by this way. Does anybody need to write down their email address? Here's an extra card if you wanted. No? No, you just want a card. There you go. Okay, thanks everybody. You're so patient. Just having fun. Woo! Okay. Those are mine.
Got a pile.
Ooh, there we go. Okay. Any other? Okay, thank you. This is fun. This could be and this is for the drawing, but of course, so I can be in touch with you and send you those little notes. Like last week, let me just, no, thanks. I was just playing around. But seriously, like last week's radio show, what we talked about was financial planning for small business owners because it's so different, because your business is your financial plan. And that was our radio show last week. And they're free in podcast. You can catch them on iTunes or while you're out and about. So I hope you enjoy it. Okay. All right. Now, before I do my drawing, let me just say this real quick. So our event. So we have a few flyers in the back. You can absolutely talk to Daryl and Emran for more information about the training and also this little day. I know you guys get hit up with people coming selling these expensive boot camps. This is a full day for $200 and you get lunch. And it's at the Irvine Marriott. and it's right around the corner from my office, and I speak for 2 hours on my top tax strategies for the year. And Kendall's going to come up and tell you, come here up here real fast. Tell everybody what you're going to talk about here next month, and maybe what you're going to cover on the event. This guy is my gosh, the real estate guru. You and your partner, sorry.
Business partner.
Yeah, I know, business partner. So I got to give Darren some love.
To not be wearing my wedding ring, is it?
Yeah, it's okay.
Okay, so next month we're going to be here. We're going to be talking about. I don't know if anybody who needs capital to run their real estate business.
You need capital to run your business, yes? Who wants to learn how to raise millions of dollars with zero holding costs? That's what we're going to be covering next month when we're here. Now, in addition to that, on this event we're doing, Mark's going to be doing his thing on tax and legal. Isn't Mark Kohler freaking phenomenal?
Oh, no, thank you.
This guy's awesome.
Thank you. Thank you so much.
I've been a student of Mark's for 9 years. Okay? Let me tell you what's happened over those, well, the first 4 or 5, made my first $1 million, lost it. That's the sad part.
Who did it in real estate, right? Yeah.
Yeah, who didn't? But since then, my partner and I, Darren, in the last 5 years, we've been able to do 140 houses, over $2.2 million of net income. Okay, this is the real deal. We teach people exactly how we do what we do. Mark's going to do his thing on tax and legal. Then his partner from the law firm, Matt Sorensen, is going to talk about the self-directed IRAs, how to go find other people's money to do your deals, and I'm going to bring it all together. I'm going to bring it all together into exactly how Darren and I operate our business with entirely 100% other people's money. Over $2 million net profit into our business, and how much have we invested? Zero.
And I've set up all their LLCs and know that it's for real. And also, all those deals were done in California.
Yeah, except for 40 of them. 40 of them were now in Illinois. In fact, that Series LLC you set up is one of my clients.
That's right. Okay, that was in the last year and a half.
Yeah, that's the ones in Illinois. 40 of them in Illinois have been in like the last 8 months. I mean, we're buying these little meth labs that Mark's talking about. We're fixing them up, rehabbing them. We're all in. We're selling them at 25 grand. They cash flow $400 a month.
Who's going to buy them?
Daryl and Imran. And a lot of other people that want this inventory. So it's going to be a killer event. We won't waste your time.
Yeah, a couple thoughts on that is that if you're looking for inventory in other states, they're going to have their inventory in Illinois. We're going to have 2 or 3 other sponsors that are going to be there with properties around the country that you can find. You don't have to buy anything. And by the way, it's not going to be another upsell to another whatever. It's just for a day, 3 speakers, 2 hours each. We're going to have lunch provided, and it's included, and we're going to do a Q&A panel during lunch. So if you have a bunch of questions, bring them. I think you'll really love it. And Matt's, guys, the highlight really is almost Matt Sorensen in a lot of ways. He is speaking all over the country. His new book, The Self-Directed IRA Handbook, is huge. So I think it'll be really good. So if you can make it. So there's a flyer. You can register at retsummit.com. That's www.retsummit.com. And the first, I know this sounds dumb, it sounds like so Ginsu knife, seriously, but we literally just we went live with the website this week, and there's only 100 seats at this Irvine location, and the first 25 get $25 off. So the promo code is 25 what? What is the promo code? Oh, text Justin real quick. He told it to me, and I thought, oh, that'll be easy to remember. 25, yeah. But anyway, we'll get your promo code. But if you sign up, and it's $25 off for the first 25 that sign up. Let those guys know. There's a flyer. And it's March 28th. It's the last Saturday of this month, so you got plenty of time to plan for it. Starts at 9 a.m. And my kids will be there. Helping check people in. They're my little employees. It'll be fun. And I'm the first 2 hours, so you want to be on time. And I'm going to cover my top tax strategies of the year. We'll hit all the hot ones that I know will save you a lot more than $200 for coming for the day. When Kendall starts to talk, you can leave if you want. Boring. No, I'm just joking. He's awesome. So please come. Then for those that are like, Mark, I don't want to come to your event. I just want more of your tax and legal videos on all these topics and more. And if you wanted a book tonight, if you don't win the book, I give you the book and also my Lawyers Are Liars on MP3 and PDF. And if you go to my website, it's almost like $800-900 for all my little videos. Whenever I do a speaking event, it includes QuickBooks training videos, 15 videos on QuickBooks, plus 20 tax and legal videos and all this for $300. I just bring it. It's not a big sales pitch. You know, I hate being salesy. But if you want to check that box and fill this out tonight, I'll give you a book. I have about 10 or 15 books. If you just wanted to buy the book, it's $30 for both books in all versions, except for the print in Lawyers or Liars. So it's 5 versions of the 2 books. So anyway, I'll be in the back for a bit. And anyway, I hope you guys had a good night. Thanks for letting me. Thank you. I appreciate it. Thanks. Thank you. I appreciate it. It was fun. And I appreciate letting me be a little sales-oriented to help pay the bills. I don't get paid to come out and speak tonight. My wife's like, where are you at tonight? I'm in San Diego. So, okay, I'll draw this. So, Daryl, help me out. Okay. Go ahead and pick one, any one. Okay, no, I'm just joking. I don't know who that was. Okay.
You just
all right.
on the table.
Oh, you throw them down.
Throw them down.
Make a mess.
Yeah.
Don't look, don't look. Just grab one. There you go.
Mine's not in there, so it doesn't.
Woo!
How about that one?
It is Brian Cambler.
Where's Brian? Where's Brian?
Have to be present to win.
Brian, all
There
right.
he is. Woo! Okay. All right.
Wait. I mailed him a copy of your book a few months ago. He's going to give it away.
What? Oh. Well, hey, you were going to give it away, right? Okay, I'll draw one more. You draw one. Close your eyes. You can draw your own.
Sorry, Brian.
Who's that? I'll read it. Roman Cedillo?
All right, Roman, yes.
There we go. Roman. Thank you. Thank you so much. I like that shirt, too, by the way. Okay. Well, don't leave yet. These guys got to wrap it up. Thank you so much for having me.
Thank you, Mark.
That was so fun.
Hey,
wow.
thank you so much.
Woo! No.